All right, let's dive right in. In today's explainer, we're tackling a huge question. How can you actually start building wealth in Kenya with, say, just 5,000 shillings a month? Well, we found 5 really powerful and honestly, surprisingly easy ways to get started.
There's this common idea, right? That you need a massive pile of cash to even get in the game of investing. So you wait, maybe for a bonus, a big deal to close, some kind of windfall. But what if that's the very thing that's holding you back?
And this right here, this quote really gets to the core of what we're talking about. The whole point isn't to wait around for some big life-changing event. It's about making small, smart moves a regular part of your life, turning it into a lifestyle. That's how you actually build wealth over time, bit by bit.
So, here's what we've got on deck. We're going to find a backdoor into the bond market. We'll look at how you can own a slice of real estate. We'll get serious about your future self, check out an all-in-one fund, and finally, we will nail down the absolute perfect place for any beginner to start.
Okay, first up, a really clever way to get into the bond market without needing a ton of cash. Let's talk about fixed income funds. Okay, check this out. This is the hack right here in plain sight. If you wanted to buy a treasury bond straight from the government, you'd usually need at least 50,000 shillings. But with a fixed income fund, you can get into that same market with as little as 2,500 bob. That is a massive, massive game changer. So, how on earth is that possible? Well, it all comes down to something called a collective investment scheme. And honestly, the carpooling for investors analogy is just perfect. Imagine a fund manager collecting your 5,000 shillings and thousands of other people's money to create one giant pool big enough to buy those expensive bonds. So, to break it down for you, these funds get you into both government and corporate bonds, which are generally considered low to medium risk. Now, here's a word of caution, and this is super important. Some funds will guarantee your initial investment, but others don't, so you got to do your homework. You can look into funds from places like Sanlam or CIC to see how they work.
All right, so bonds are great for stability, but what if you've always dreamed of earning that sweet rental income without needing millions to buy a building? That, my friends, brings us to our second option, real estate investment trusts, or REITs.
Now, the real magic with REITs is that you're not just buying a piece of dirt and hoping it's worth more someday. No, no. You're putting your money into properties that are already making money. Think about it. Things like student housing or commercial buildings that have tenants and are collecting rent from day one.
And get this is the real kicker. In Kenya, it's actually required by law that REITs pay out at least 80% of their profits back to you, the investor, in the form of dividends. That is a huge, legally mandated payout. It's a really simple process when you think about it. The fund gathers everyone's money, they go out and buy these income-generating properties, they collect all the rent, and then they pay out the profits directly to you. It's basically passive real estate income, but without all the headaches. Okay, so we've got income from bonds, income from property. What's next? Well, now it's time to invest in the single most important asset you have, your future self. It's time to talk about personal pension funds. This is a really tough statistic to hear. I mean, think about it. Nearly 4 out of 5 working Kenyans could end up poor in retirement just because they're not planning ahead. It's so easy to push it off, but trust me, ignoring this is one of the biggest financial mistakes you can ever make. So, why is starting now so critical? 2 words: compounding interest. Picture this. Someone who starts putting away just a small amount every month in their 20s can easily end up with the same amount of money as someone who has to frantically save a much bigger chunk of their salary every month starting in their 40s. It's all about giving your money time to grow on itself. The message here is crystal clear. The biggest advantage you have right now, especially in your 20s and 30s, it isn't money, it's time. And you don't need a lot to get the ball rolling. Most personal pension funds here lets you start with just 1,000 shillings a month. The most important thing is just to start.
Okay, once you've got that long-term plan cooking, maybe you're feeling a little more adventurous. You're ready for a bit more risk if it means potentially higher returns. Well, that's where something like a balanced fund comes in. Think of a balanced fund as your all-in-one instant diversification tool. You know the saying, don't put all your eggs in one basket? This fund does it for you. It automatically spreads your cash across different things. Some in safer bonds, another chunk in higher growth stocks, and a little bit is kept in cash.
But, and this is a big but, there is a trade-off. With more reward comes more risk. A balanced fund does not guarantee your initial investment. The value can and will go up and down. So if the stock market has a rough month, so will your fund. This is really for someone who is comfortable riding out those waves for better growth down the line.
And that brings us to our fifth and final option. And honestly, for anyone just dipping their toes into investing, this is it. This is your perfect starting point. We're talking about money market funds.
So what is a money market fund, or MMF? It's kind of a hybrid, the absolute best of both worlds. It gives you the safety of a savings account, meaning your initial capital is preserved, but it also works like an investment, earning you really competitive interest that's calculated daily. You literally get saving and investing in one package. This makes it just an incredibly useful, flexible tool to have in your financial toolkit. You can use it to build up that all-important emergency fund, you can use it to save for short-term goals like school fees or vacation, or you can even use it as a holding account to build up enough cash to make one of those bigger investments we just talked about.
Look, after going through these 5 options, we are officially done with excuses. The tools are out there, whether you're starting with 1,000 shillings or 5,000. Remember, the goal isn't to get rich overnight. It's to build the habit, to make investing a lifestyle, not just some event you hope for one day.
So that just leaves one question, the big one. You've got the roadmap, you know the options, you have 5,000 shillings sitting in your hand. What's your first move?